All right, good morning, everyone, and welcome to Market Mondays. My name is Sing Yao, and I will be your host for today. Dylan Workemasinger is taking a break today as he has to attend to some meetings. Um, s- just a recap on markets. Stocks slid further on Friday because of a mix of news related to tariffs and markets taking a more cautious view ahead of the U.S. non-farm payrolls report. The Dow fell 400 points after President Donald Trump said he was planning reciprocal tariffs on trading partners, and the jobs report, which came in weaker than expected at 143,000 new job addition versus consensus of 170,000. Now, markets have indeed taken a noticeable turn since the tariff wars began and the announcement of China's DeepSeek, which is open source and, as you can imagine, cheaper to operate. US techs remain under heavy pressure, and this was further exacerbated by lower earnings guidance from tech majors that have reported, which counts Amazon and Alphabet. The two key takeaways here is that markets never actually believe that Trump is serious about prolonged tariffs and the breakdown of the entire global trading order. Secondly, which is actually very important as the markets are developing right now, is that big tech is not immune despite all of the promises of AI. So with even less room for error, stocks are now very expensive compared to when they were at 2018. And analysts are generally very optimistic, are still very optimistic about the outlook, and they are expecting generally about 17% corporate profit growth for this year. So with the deluge of incoming news flow, including President Trump's relentless campaign of trade protectionism, do you buy, sell, or just give up? So I would first like to invite our chartist Amirul to the show. Amirul, can you first walk us through your observations for the S&P 500, STI, and Hang Seng so that we can set the context right for everybody? Amirul?
Hi, Sayang. Thanks for having me on the show. So, for that, let me share my screen first. Okay, can you see my screen now? All right, so let's take a look at the S&P 500 first. So, obviously, if you look at the chart, if you zoom out the chart a bit, this S&P is still showing that it is still in a nice uptrend with further upside. But then I was optimistic that the index could actually go higher, not until last Friday's decline, because if you look at last Friday decline, it has actually made a big red candle over here. So this shows that a further decline might follow suit, because why? It has actually created or confirmed a new downtrend channel. So if I draw a line from here to down here, you could see that it's actually creating a new downtrend channel from this line over here and this line over here. So if you look at the decline last Friday, it still maintains within above all key moving average lines, which is still a good bullish sign. But then again, whenever a new downtrend channel has been formed like this one, you could see from the previous move as well, like this one also, you could see that further pullback is going to occur and might going to push the index below the 50-day EMA line. So I believe probably further weakness might follow suit. But then again, if you look at the momentum oscillators, it is still in the good territory, in a positive reading. So a further rebound or a stronger rebound might follow suit. But then again, since if you look at the previous pullback over here, whenever they do a pullback below the 50-day line, like for example, like this one over here, you could see that the price rebounded higher. You could see another example. It broke below the 50-day EMA line before it rebounded higher. So where's the level that you might think that when it goes through that level, it might go for a further weakness? I'll say take a look at the previous high-low structure over here. So let's say if the price still decline, no, the index still decline, and then it breaks below this line, that's the level that you think that maybe this could be a bearish continuation move. So that's it for XPX. Let's look at STI. So for STI, to all the Singaporeans out there, congratulations, because the STI just make a new 52-week high this morning with a gap up. You could see there's a strong gap up this morning. Well, it's something expected. Is if you look at last Friday, it made like a big candle over here, right above all key moving average lines. So it is been something expected that is going to create a new 52-week high. So is there any still potential further upside? Well, I believe there is, because if you look at the RSI reading, it is still below the overbought territory. So I think the index could actually still push higher. But then again, if you look, the price has been gap up, but then towards the latter of the session, it has been in a mild decline. So, which means that the gap up this morning is only for the first few hours of the trading hours. So I would expect that the price or the index to consolidate right around this range over here before it actually goes higher. If you look at the RSI reading, right, the even though it's approaching the overbought territory over here, if you look at the previous price movement, it has been in an extreme overbought territory above the 75 reading actually in the previous movement. So if you look, for example, right around this range over here, it has actually been going higher before it actually went into a pullback phase before it moved higher. If you look at this reading again, this has been, I think this is almost 80, and then before it actually consolidate, building a new base around here. So I will expect the STI to move right around this range over here. It's going to go higher and it's going to build a new base before it actually break above this pattern again and actually make a new high. So that's it for STI. And lastly, for HSI, HSI is interesting, right? So if I zoom out a bit, in a Fibonacci or in a Elliott wave perspective, right? Currently, HSI is currently in a motive wave 5. Last week, rally has actually confirmed that it has been in this motive wave 5. You could see that there's a strong rally. It has rebounded. It has found like a strong support from its 200 EMA before it rebounded higher. It has broken above the 38.2 retracement level and also the 23.6% Fibonacci retracement level. And most importantly, I believe that HSI could still have a further upside because it actually has broken above this important resistance line over here, which coincides with the 38.2% retracement level. So it was a stronger gap up this morning. So, and then I believe it could actually take out this motive with 3 high over here and also make a new high soon. So that's it for me for all the 3 outlooks from the 3 charts.
Okay, thanks, Amiru, for that very interesting insight. So to summarize, basically we're saying that there's still more weakness to be expected in U.S. markets, but Hang Seng and particularly the SDI still looks very promising at this point in time. I'd just like to basically just refocus on the Hong Kong market. Now, last week, actually since the announcement of DeepSeek, the China techs have actually been doing very well. But in addition to the tech sector, the Chinese automakers have also come into focus. And particularly, we saw stocks like Geely, perform very well over the last couple of sessions. Can you give us your take on Geely and perhaps if there are any other stocks that you would like to highlight for our audience, please share it with us here. Amirul?
Okay, sure. So I have a few charts that I think it's worth to look at. So let me share my screen again. So over here, first we have Geely Automobile. So obviously you could see that last week Geely has been in a strong bullish move as it just broke above the rounding base pattern over here. So this is the rounding base pattern. So it actually broke above this pattern last Friday with a high volume, and this morning, even though it tried to actually move higher, but then expected the pullback is coming in because the momentum oscillators has been in an extended territory. But then again, for Geely Automobile, you could see that it's way above the 21-day moving average lines over here, which could be a dangerous sign that a further pullback might follow suit. So I recommend to all of you, if you still have not earned any Geely Automobile Holdings stocks, so probably you want to wait for a further retracement, probably somewhere around this. Maybe you're going to find a strong support around its previous rounded base pattern neckline. Maybe it's going to consolidate at this before it rebounded higher. I believe the uptrend remains steady. There's still a further upside, but maybe wait for a further retracement first. But then I think there's actually a better alternative than Geely Automobile and a strong automotive name too, which is Li Auto. So Li Auto is a stock that we recommended in our market insight this morning. So why we recommended this stock in the first place? Because it actually made a strong bullish reversal breakout as it just broke above the double bottom pattern. So if I draw a line around here, and if I draw like a slope line over here, another curve line over here, you could see that it has just made a strong bullish reversal breakout last Friday as it just took out this double bottom pattern. And if you could see, the volume was very high. And you could see also this morning it has been higher, up by 2.7%. So we believe there's still a further upside. So our next resistance target is at HKD 114. I believe this is something that could be achieved. And if you look at this moving average crossover over here, where the 21-day EMA just crossed above the 50-day EMA. So the short-term outlook still remain positive. And this breakout over here also signifies that it's primary downtrend that started from this line over here, given the lower high structure has been tapered down. So I think instead of Geely Auto, if you want to still look for a better alternative for automotive name, Seng Yao, I think Li Auto is showing a better chart setup.
Excellent. Thank you very much for that, Amiro. All right, I'd like to draw attention back to Singapore right now. And the next stock I would like to talk about is actually SGX, which has drawn a lot of attention of late from the release of its first half results. And also, I think markets are basically positioning ahead of the upcoming MAS review. It's in motion, as everybody knows. But I think the outlook for SGX looks very promising with the likelihood of certain changes that may potentially benefit the stock. So earlier we did a pre-recorded interview with Tillen on SGX. So we'll now head to that playback right now to have Tillen walk you through what he sees in SGX.
Hi, Sengyo. We upgraded SGX to a buy with a new target price of $14.16. The first half 25 results were strong, and the conditions that drove those results are likely to continue. And in fact, they might actually get stronger. This is across all their business pillars. Take a special note of their cash equities business. We saw average daily trading value, or ADV, rising about 9% on a half-on-half basis, which actually led to trading and clearing revenues increase 18% for the same period. This shows there's massive operating leverage SGX has on this particular pillar. We estimate that anything over around 600 million of ADV actually flows directly down to SGX's bottom line. The recent catalysts for ADV in Singapore, safe haven flows, high interest rates, corporate capital returns, are themes that are likely to continue, especially looking back what has happened in the past 4 weeks. Management is claiming that they're seeing a very strong IPO pipeline as well. And interestingly, it's coming from sectors such as new economy, consumer, healthcare, apart from their very traditional stronghold of the REITs. Plus, there's the MAS review, which actually may throw up some initiatives to actually ease IPOs as well as drive secondary market volumes as well. So we've upgraded market velocity by around 5 percentage points for the next 3 years versus the 32% that we've seen in the past 10 years. We don't think that's actually much of a stretch, given that in the first half, velocity was around 40%. And at that sort of velocity, the average daily turnover is around $1.2 billion. So I think these are fairly reasonable assumptions to make. At the same time, we saw pretty strong operating capabilities coming from the fixed income as well as the commodities business as well, along with the equities derivatives business. Clients are largely hedging and trading assets linked to China and India. Looking at the Trump trade war, we think the volatility and uncertainty around these economies are unlikely to abate. And in fact, they might actually get even more. So management also has been broadening the client base that uses these services. So again, we think there are potential for upgrades there as well. So all of this makes us pretty bullish on SGX as a market as well as a stock. The only sticking point is dividends, which we don't think will see a big jump, but there are enough catalysts to drive growth. With that, we are upgrading the stock to a buy with a $14.16 target price. Thanks, Danielle.
Thanks, Dylan. So everybody, please remember 1460 target price. That's what we're shooting for, right? Okay, coming back to Singapore-related companies, Grab has also kicked up a bit of market's attention in the past week. There was some market talks that were first started by a Bloomberg reporting that a Grab Gojek merger scenario has basically been rekindled. So I'd like to basically now come to invite Husseini to the program and basically just talk about what this actually means for investors who are thinking about getting into Grab or GoTo, which is parent company of Gojek, or what that might mean on valuations. So Husseini, hi. Does this market talk on the Grab Gojek merger, does this surprise you at all, Husseini?
Uh, hi, Sengyao. Thanks for having me. Uh, no, it is not a big surprise for me because we had been flagging this to the market since at least for the last 9 months. Okay, so what happened is that when we were in Jakarta last year, there were quite a bit of market chatters of this potentially going through. And on the back of that, last year we also put a merger scenarios that if this goes through, what are the regulatory hurdles and what are the potential valuation implications on the back of that. So essentially, it doesn't came to me as a big surprise.
Okay, great. So what are the key differences in regulatory risk with this merger? As we all know, ByteDance tried to set up TikTok Shop in Indonesia back in 2023. This was later banned, and then that led to other forms of ByteDance entering the market. How does it compare with Grab Gojek's merger scenario?
All right. So, in my view, these both are very different in nature. So, see, the TikTok ban in Indonesia, I think in late 2023, was for some other reason. Essentially, it was with the view to separate TikTok's social media arm, which was short video platform, from the e-commerce platform. Okay, so that ban was linked to that, and I don't think that the Grab merger, potential merger between Grab and Gojek, have any links to that. Now, having said that, one issue we see though is the concentration risk, as the merger could create a dominant. So the merger could create a dominant player in Indonesia with almost 80 to 90% market share of the ride-hailing services. In Singapore as well, the Mergco will have a dominant market share. Now, the way we see this potentially going through is that, so if the merger has to go through, we think Gojek will drop its operations in Singapore. Singapore regulator, in our view, won't allow this merger to go through in Singapore as they are quite averse to concentration risk. It won't be a major loss for the Mergco or for Gojek, as Gojek has a single-digit market share in Singapore. Now, Indonesia is different. Indonesia, although they will have a dominant market share of almost 80 to 90%, but if the regulators see the Mergco from a different lens, i.e., from the or as a percentage of total road transport share, then we see limited risk, because as a percentage of total road transport, which includes buses and taxi services, cars, and things like that, the market share of Gojek and Grab combined will come down to almost 20 to 30%. So in Indonesia, the way the regulators see the merger, whether just from the ride-hailing point of view or from the point of view of the overall transport sector, that will define whether the merger will go through or not. In our view, the merger is likely to go through.
Okay, great. Thanks for that. So if this merger goes through, hypothetically, what is the most likely setup on the merger structure? And what is the valuation upside to Grab and GoTo at today's prices?
Sure. So we see two potential merger scenarios. First is that Grab overtakes Gojek. And now Gojek is the ride-hailing and food delivery arm of GoTo, right? So in the first scenario, we assume that Grab overtakes Gojek, and in turn, GoTo takes a minority share in Grab as a list co. And on our estimates, under this structure, GoTo will take around 8% market share in Grab. And now this scenario is exactly same as the Grab and Uber deal. I think somewhere around 2017, 2018, wherein Uber exited and passed on its ASEAN operations to Grab, and in turn, Uber took a minority stake in Grab under the Listco. So that is one of the scenario. The second scenario could be Grab and Gojek merge their Indonesia operation, ride-hailing and food delivery operations in Indonesia, and both of them, which is GoTo and Grab, takes minority or takes a stake in the unlisted merged-co. As you can see on, I think on figure 10 of the report. Okay. And so that could be the second scenario, and that second scenario is exactly like the TikTok shop and Tokopedia merger, which happened early last year in Indonesia, wherein TikTok GoTo passed on its e-commerce business, which is Tokopedia, to TikTok shop, and in turn took a minority stock in the unlisted TikTok shop operations in Indonesia. Now, from the valuation point, the third point to note is that as such, we don't see a potential for an all cash deal. Okay, so likely the merger scenario 1 and scenario 2 are likely to be a stock deal or a merger of two unlisted entities. We don't expect it to be a cash deal because we don't think Grab is likely to take or use cash to buy a loss-making operation of Gojek. Now, just finally on the valuation standpoint, from the valuation standpoint, we see around 8 to 9% upside to our Grab target price. And for GoTo, we see around 3 to 5% upside. So we see Grab to be a bigger beneficiary of this merger compared to GoTo. And the areas of synergies, in our view, will be lower incentives for the drivers and consumer, as they will have a much bigger scale, so they don't have to incur so much of incentives, as well as lower fixed costs such as cloud costs and things like that.
Okay, thanks very much for that, Husseini. So in short, basically better upside potential on Grab. Yeah. Okay.
Yes, you do see that right. Thanks.
Thank you very much for that, Husseini. Okay, we have about 5 more minutes, and I'd like to basically invite Krishna, our REITs analyst, to basically give us some coverage on the sector, particularly on CICT, which is Capital Land Integrated Commercial Trust. Krishna, if you can hear us, let's first break down the results of CICT into the retail portion and the office portion. For retail, what's the effect of Aeon Orchard's acquisition on the retail portfolio? And basically, can you give us some sensing whether the overall rental reversion momentum that we've seen so far is going to stay or moderate in 2025? Krishna?
Thank you, Sengyao. Thank you for having me again. Happy New Year to everyone. So yeah, I think CICT, they did have some sort of impact.
Krishna, I think your mic.
Yes, hold on. Am I audible now? Hopefully, yes.
Yes, we can hear.
Okay. So as I was saying that, yes, the Aeon Orchard acquisition, they had a 2-month impact on the portfolio stats. Management did explain the impact of that. So it is mostly on the tenant sales side of things. So if you exclude that, I think include that, then it is about 3.4% increase in terms of the tenant sales year to date for the 12 months. If you exclude that, it is relatively more flattish. And then if you then subdivide that into the suburban and downtown, then downtown was for the 12 month was slightly about down 1%. And 9-month also was similar numbers. So I think that the growth that you saw because of the Aeon Orchard inclusion was actually not there on a same store basis.
Okay, all right. Then let's talk about the office portfolio. What are the key challenges for the domestic and particularly the overseas office portfolio holdings?
Yeah, I think it's an ongoing sort of narrative. I think the trading conditions are a bit challenging. Management did allude to, and this is a similar narrative along with what the peers have been saying. The CBD offices is seeing some traction coming back. There has been, the tenants who have moved from sort of lower grade city fringe suburban offices to a better spec assets, taking advantage of, the lower rents that's there on the CBD side of things. So CBD offices are seeing some stabilization. However, the challenging conditions, and especially for the overseas portfolio, does remain in sort of the poorer specs, suburban sort of assets. Fortunately, I think CICT in its portfolio is seeing some stabilization of the office occupancy in Australia. Germany is still seeing some tenant downsizing. So I think broadly it is an unchanged narrative. We are seeing some stabilization of occupancy, but having said that, I will not rule out that, if some large lease renewals come up, then there can be some potential right sizing by the tenants. But having said that, and this is for Singapore, you do not have much of supply in the medium term. And so if the economic growth picks up, we can see a quick swing in the demand metrics.
Okay, can you remind us again what's the dividend yield on CICT and whether the DPU is per your expectations?
So I think in terms of the dividend per share, we are expecting flattish to slightly about 1% growth next year. And this is primarily as the higher interest costs that which they have already guided is mitigated by the stabilization of the properties that are undergoing asset enhancements, which is the Galileo as well as in Singapore, the IMM Mall. Plus, they will have the full year contribution of the Iron Orchard as well. So it is flattish to slightly up distribution. In terms of the yield, it is slightly sub 6%. So I would say it is not as deeply discounted as some of the other names, but relatively more stable and from an A-rated credit.
Okay, great. Thanks very much for that.
Thank you.
We look forward to your further review of the REITs market as the quarterly results get underway. Thank you very much for that, Krishna. Okay, so we've come to the end of our program. I'd just like to highlight that there is an upcoming roadshow with OUE REIT. This roadshow will be held by Zoom. And that if you're interested in attending, it'll be at 6 p.m. Singapore, Malaysia time. Please, your sales representatives will be able to get you the Zoom details to get into the program, right? So with that, thank you so much for spending your time with us this afternoon. Please continue to check back with your sales reps and with us with any questions that you may have on the markets, and we'll do our best to get back to you. With that, thank you very much again, and happy hunting in the market.